Hello, and thank you for joining our webcast today. I'd like to get started right away by jumping into our discussion on the state of Greece. It certainly has been in the news a lot recently, and essentially Greece is now down to the point of deciding whether or not they will pay back their loans or default, and whether or not they will stay in the euro or leave and perhaps revamp the drachma, their former currency. So to start off, perhaps some perspective would help. In these volatile times, it can be beneficial to take a step back and review what has taken place before. And when we do, we realize that Greece has been in default 1 out of every 2 years, or 50% of the last 180 years. So this current state that Greece is in really is no different. In fact, 2,400 years ago in Greece, one of the wealthiest organizations in the world, the Temple of Delos, had the misguided strategy of loaning money to the 13 Greek city-states. All 13 states defaulted and eventually paid back the temple at 20 cents on the dollar, so it was an 80% loss. Many economists, including Rogoff and others, have done great work pointing out that the worst credit, the riskiest loan to make, is sovereign debt, or lending to countries. So perhaps we should not be too surprised with the current Greek situation. Now let's see what's going on in Greece currently. In a scene straight out of It's a Wonderful Life, Greek citizens have queued at ATMs over the past week to withdraw whatever cash they can. Some are concerned that their euro deposits could be redenominated to a new drachma currency, or worse still, that their assets could be frozen and or confiscated, as happened in neighboring Cyprus just 2 years ago. In what became known as the Cyprus bail-in, the Cypriot government seized half of everyone's savings above 100,000 euros directly from customer bank accounts. In response, this past weekend, the Greek government announced capital controls in an attempt to slow capital flight. Here we have a list of those capital controls. Now, this list is being updated seemingly every hour and is subject to change at any moment. But we can go through them here. The banks will remain closed until July 6th. Daily ATM withdrawal limits of 60 euros have been set. Wages and pensions will be paid. No restriction on foreign tourists using ATMs. And electronic transfers will not be affected, so credit cards and debit cards will still work. Now, obviously, this is a stopgap measure, and it's not meant to deal with the actual underlying causes of the Greek crisis. So what are the underlying conditions and causes? First, we have the question of currency. Will Greece continue to use the euro, or will they create a new drachma, as drachma was the name of their currency prior to joining the euro? This chart is a visual of the nations that are members of the European Monetary Union, or the EMU, and thereby utilize the euro as their currency. And it helps provide insight into the number of players that are involved. Ultimately, Greece will decide whether to stick with the euro, and it's not a simple choice. There are pros and cons. So if Greece stays in the euro, one of the pros would be the stability of the euro itself. Over the past 15 years, the euro has actually strengthened against some currencies, including the dollar, and hasn't experienced heightened periods of inflation like Greece's prior currency, the drachma. Now, one of the cons of staying in the euro for Greece would be the inflexible nature of outsourcing their monetary policy. And what I mean by that is, in a way, the euro system is very much like the gold standard, where you have a set of countries that have joined a monetary union and they've all outsourced their monetary policy. They can't, on a singular basis, decide what their short-term interest rates will be or how weak or how strong their currency will be, because it's tied to something external from their own national decision-making policy. Conversely, if Greece were to leave the euro, one of the pros would be that they would have the flexibility to undertake their own monetary policy. For example, debasing or weakening a new drachma currency, making their goods and services relatively less expensive. Now, some of the cons of leaving the euro would most certainly be short-term in nature. And what I've mentioned here first would be the destabilization of capital flows. If they were to start a new currency, businesses, things that have accounts receivable, accounts payable, would have to redenominate and have to make those calculations in real time. And they wouldn't know up front what the new drachma would necessarily be worth in dollars or euros or Japanese yen. And the other is domestic capital flight. A good example of this would be Greek citizens moving their capital offshore due to fear of what a devaluation would do to their wealth. So now let's talk about the Greek debt situation. The cartoon here has Atlas having put down the world and taken up the Greek debt, and now he's regretting that decision. And to be clear, the Greek debt load is immense, and in our view, unserviceable. Here you see that although Greece has undergone bailout after bailout, the Greek debt actually continues to climb. Okay, so here's a breakout of the creditors. Greece has borrowed 318 billion euros, and these are the entities that have lent Greece the money. Private investors, and these would be banks, hedge funds, mutual funds, other investors, hold around 12% of the outstanding debt. And you see that nearly 70% of Greek debt is owned by the IMF and the EFSF, which is the European Financial Stability Facility. And that was a resolution mechanism that was adopted in 2010. You also see that the European Central Bank, or ECB, and the Euro system hold about 9% of outstanding Greek debt. Now, with respect to the European nations that are creditors to Greece, this chart is pretty interesting. It shows the European national exposure to Greece and the corresponding size of that exposure with respect to their economies. And what sticks out in my mind on this chart is that the dialogue often seems to be between Greece and Germany. You often hear their finance ministers countering each other in proposals. Interestingly, although Germany has the greatest nominal exposure to Greece, and you see that in the orange column of nearly 60 billion euros, when you look at the blue column, you realize that they have a relatively low exposure with respect to their GDP, coming in a little over 2%, less than some other European nations like France, Italy, and all the way to the left there, small Portugal with over 3% of their GDP at risk, crediting Greece. So to put Greece's debt load into context, here we have compared Greece's debt to GDP ratio to that of other Euro nations. Clearly, Greece stands out as the nation that has borrowed the most relative to its economy size. That would be somewhat akin to having a very large credit card balance in relation to your given income. Now this chart gives us a little different perspective. Here we have plotted the size of different nations' debt. These are the same countries listed as the last chart, but it depicts an entirely different picture. Here you see that Italy's debt outstanding is almost as large as Germany's, over 2 trillion euros. So market players aren't just keeping an eye on Greece, they're also paying attention to other large borrowers in southern Europe. We often hear the question, how can a small country like Greece, a country of 11 million people, an economy, GDP of roughly 250 billion euros, or roughly the size of Facebook, cause such turbulence? And part of the real concern here is whether or not a domino effect takes place. If Greece decides to default on their debt and not pay back creditors, will that ultimately cascade into other nations defaulting? And it's important to remember, in aggregate, the peripheral Euro countries, Greece, Ireland, Portugal, Spain, and Italy, have together more than 3 trillion euros of debt outstanding. Here you see a cover from The Economist magazine, and it's entitled, "Acropolis Now, Europe's Debt Crisis Spins Out of Control." Interestingly, this cover is actually from May of 2010. So this Greek episode has been ongoing for 5 years now, and sadly the stopgap measures that have taken place over the last 5 years have been band-aids, which effectively extended the status quo and did not serve any of the underlying issues. So the question is, will they continue to kick the can down the road, or will some set of actions with finality be undertaken here and now? Well, although we at Quantitas Capital cannot say what will certainly occur, I would like to share some of our views on the possibilities. Now, there are many moving parts and different scenarios that one could work through, but I think the viewpoint of the largest creditor, Germany, is somewhat interesting to think about. If Greece were to leave the euro certainly, to some degree, would actually strengthen against different currencies. Germany, after all, is the world's largest exporter, and a relatively weaker euro at least provides somewhat of a tailwind to Germany's exporting economy. Accordingly, Germany has repeatedly expressed a desire to keep the euro together. Today, Angela Merkel, the Chancellor of Germany, was on record saying that if the euro fails, Europe fails. Now, from an investor point of view, in light of a drachma redenomination, we would be looking for domestic Greek businesses that would have a cost basis in drachma, but would be bringing in revenue in some foreign currency, whether it be euros, US dollars, Japanese yen, what have you. Now, with respect to a prospective Greek default, we feel that at Quantitas Capital we have positioned ourselves relatively well. We've raised cash balances over the last few weeks, and ultimately within the credit context, we will be looking to deploy some of that cash if the heightened volatility inevitably tied to a destabilizing event, such as a default, transpires. That concludes our discussion today. Feel free to share this presentation with friends and family who might be interested in the events transpiring in Greece. Thank you for your support at Quantitas Capital. Good luck and goodbye.